Hey, what's up, everyone? Welcome to another episode of the BYOB Ask Me Anything Happy Hour. We're off to a hot start in 2026. Hope everyone's having a great start to the year. And it's been a fun day today. We had a pretty cool What the F happened this morning. We had a really good wealth webinar. Was anybody on the wealth webinar watching?
I wasn't.
With Busey Bank there, talking about some different ways to borrow from policies using cash value, lines of credit, and getting into a little bit more with the vault and some good stuff on there. So if you missed that, the recording we'll put on the YouTube channel, YouTube at the Chris Noggle on Saturday, just like every other wealth webinar is put on there. But start getting your questions over in the chat box. We're going to do a quick little around the horn, and we'll be back to answer all your questions in just a moment. All right, welcome to Ask Me Anything, the weekly spot to be to answer all your questions around infinite banking, becoming your own bank, alternative investing, and any other topics that we want to get into. Let's turn that silly banner off. But yes, this is not financial advice. We are licensed insurance agents. When you schedule a call with us, we do become your agent, and we'll talk to you more specifically about what that looks like for your situation. But these webinars, these online shows are typically for fun, educational purposes, and a lot of times our opinions. With that being said, we will answer all your questions to the best of our ability using all of our years and years and years of experience, and we are happy to help. We will also be sharing a link where if you would like to schedule a call with our team to talk about your specific situation, ask your specific questions. It's awkward asking financial questions in a public forum. So get those calls scheduled with our team, and we will answer those questions. When you schedule a call, it will be with one of the people you see on this screen, which is pretty cool. So with that being said, we'll introduce everyone and we will get rocking here. So I'll pass it over to the man from the West Coast that likes the cold weather and poisonous spiders, Mr. Brian Fouts. What's up, Brian?
Hey, everybody, Brian Fouts here up in North Idaho. It's actually very cold here. No spiders, nothing like that. But out here in the country, doing a lot of calls and stuff. Yeah, this week's been pretty interesting. A lot of unique questions, a lot of unique policy structures. So it's been a lot of fun, which we love. Infinite banking because it is unique and it is specifically designed for each person. It is not an off-the-shelf cookie-cutter system. So love doing this and look forward to hopping on some calls with all of you. But with that, I'll send it over to Tess.
Hi, I'm Tess Hulick, and I've been around this campfire for about 6 years as an agent. I really just kind of celebrated year one, I think. Grateful to be here. I know that this is a not known concept for many people, but the idea is we become known for many very quickly. Thank you. And now to Linus.
Thanks, Tess. Linus Nolt here from Hopkinsville, Kentucky. A cold, windy day here in the Bluegrass State, but a beautiful one, I'll tell you what. So yeah, I'm happy to be here and help with any questions and insights I can with the infinite banking concept and all kinds of related stuff. Happy to be here. Jason, take it away.
Thank you, Linus. Thank you, everybody. Hello, hello, hello. Happy Wednesday. Happy hump day. Excited to be here. As always, I love the questions. I love how we all have different answers to the same exact question. I always find that super interesting. So excited what we'll learn to get today together and help you guys, guide you, because what I've realized is we don't have money problems in this country. We have money patterns, and a lot of us have pretty poor money patterns. So let us help you get on the right path, answer any questions you have, and try to stump us. It's kind of fun. Over to Mr. Yenny, who loves the cold.
Yes, I do. Thank you, Mr. Simple. I do enjoy the cold, and it has not been cold enough for where I hail, and that is south of Denver, Colorado. With all of that said, yeah, I'm glad to be here, and what we'll focus on today is answering any of your questions around what we call the infinite banking concept process. Now, if you're new to this, the way I kind of look at this is there's three main use cases that people typically fall into. However, it is called the infinite banking, so there could be many. But if you're in debt, we have strategies to help you get out of debt quickly and build wealth at the same time. We have strategies for how you can fund and buy major purchases. So what are some of those major purchases? Cars, kids' college, home renovations, those types of things. And then also the third tier is if you've built up emergency funds, opportunity funds, how do you put those to work in investments you know, like, and understand to build more cash flow and run that back in the system? So we're ready to answer your questions. Thankful to be here. Like Tess said, we're always glad to be here because we're learning from interesting questions and debate. Like Jason said, we all have debates and some different perspectives. So welcome aboard. Here we go.
All right, everybody, go ahead and get those questions into the comment or chat box so we can get them answered. So we'll start here at the very top with No Garage Guy, who says, considering getting a loan from my 401k to start a policy. So I guess what you're asking is that an option? Can you do that? All that kind of stuff. So anybody want to grab this one?
Yeah. Thank you, Fouts, for your great reading. You've definitely been practicing your phonics, and I'm impressed. It depends on what you're trying to accomplish, right? So I think if you're trying to pay off a higher interest, like here's how I like to look at it. There's two of you in every conversation. There's your current self and your future self. So like if currently you're paying a lot of interest to other places because of credit card debts or other high interest debts, and maybe taking a loan out to overfund your policy, to take back control of those debts, and you have a plan of how much you're going to be paying back, and you can do both at the same time, then that makes sense. You got to look at the whole picture. So it can be a really good option to get started if you're not feeling real confident with the market or what's happening inside your retirement plan. You got problems today. That's how I would look at it.
Yeah. And another thing to keep in mind, because I've done 401k loans when I had one, I don't anymore, but I've done them before and paid them back and all that kind of stuff. What I would start with is the end goal in mind. Like, what is it you're trying to accomplish? What is that goal we're trying to achieve? And then you can answer the question, does borrowing from the 401k help me accomplish that? That's how I look at it, because I typically start with the end in mind. Got to know where our destination is so we know where we're starting from and if it makes sense. So just kind of, and it's got to run the numbers. As Jason said, do the numbers make sense? Because you don't want to get yourself into a situation where all of a sudden you're borrowing from Peter to pay Paul and you're basically digging a hole deeper. Let's see here, it says legacy. So yeah, legacy. I mean, a big part of infinite banking is that guaranteed legacy. It's there. It's going to grow over time. So when I look at the 401k, kind of my opinion, this is not financial advice, but you're doing kind of a good thing with the 401k because you're paying it back with interest. So it's growing. Even if the market goes down, if you have a loan out, you're paying it back with interest, and you got a policy growing as well. So long term, it can look pretty good. So.
And one thing I would mention too is that 401k loans, depending on your plan, you're going to want to look at your summary description, because if you leave employment, you'll either owe the money right then and there, or the plan that I was involved in before I left the W-2 world allowed me to continue making payments after I left. So just to know what the rules are if you happen to separate service during the process of having a loan out.
And I had a solo 401k at one point in time. I went from a 401k employer to a solo 401k, and I did a loan on both of them, actually. So
yeah. It's a great
I would say for No Garage Guy, I have a question for you too. I want to know what that fender is. I just can't figure out what that fender is. So tell us what that car is. But what we've been talking about too is if you do take that loan from the 401k, you've already shared that you have legacy, but there's more to the story, because you can have legacy and we want to figure out what else you're going to do with the system. And we have this ability to kind of mathematically prove it out with the vault. If you've heard us talking about the vault, we'd put that in there, we'd pencil it out, we'd figure out if you're paying down debts, if you're, doing major purchases, are you investing? So we just want to make sure the math works. So we'd really want to schedule a call. And I think, Brian, you'll probably put that out later as far as how people can do that.
Yeah. Where did that little thing that Steven shared go? He didn't give it to me, so I'll text me in a second and say, hey, where's that thing at?
Yeah, but if you want to put in the comments too with that vehicles, I want to know, because I can't figure out what that fender's off of.
Yeah,
it looks like a truck to me. It looks like an old truck.
It does look like a truck, but a picture's kind of clipped, so I couldn't tell. But anyway,
Yeah, Brian, I dropped the link in the studio chat there. You should be able to find it.
Okay, cool. Thanks. All right. Let's see here. So this is an interesting one. So this is from Mav the Pilot. So Mavi, I watched a video where it mentioned a month that you went in depth on HELOCs, so home equity lines of credit, and the infinite banking system. Unfortunately, I didn't write it down and can't find those videos. So we actually had a conversation about this recently where inside our Vault software, Chris AI can probably go find those videos.
There you go.
So,
and it was from August. So we did a session every week in August. So if you go to Chris Nagel's YouTube and you go to the playlist, you'll see a playlist for wealth webinars. And then go to about the August timeframe and you'll see I think we did 4 sessions in August, all on the HELOCs and infinite banking, but that's where you're going to find it.
There you go.
1950 Chrysler 2-door. All right.
Yeah, so wasn't what we thought. It's awesome.
Super cool.
Yeah. All right. What is in the process for applying part of this process? So David, I believe what you're asking is, what is the process for applying for an infinite banking policy? I believe that's what you are referring to. So anybody want to walk through those steps?
Who wants to do it? How about Linus? Linus, walk us through it.
Linus.
Sure. All right. So it starts with the conversation you have with your money mentor, your strategy call. Once you understand the strategy, what type of policy or what kind size and design of policy that you're going to get to do what you want to do, then yes, move into the process of applying. And it is still life insurance, so you do have to apply get approved and get underwritten health-wise and financially wise. So it is a whole process. It typically takes 4 to 6 weeks. First is, of course, completing the application and then going through underwriting. Typically, you will need to do a medical exam. It's fairly convenient. The nurse can come out to your home to do it. But yeah, once approved, then you'll get back in touch with your money mentor on another call, and you'll go over what you've been approved for and how it can work for you. See if you want to make any changes before actually moving forward and having your policy issued where you can sign and fund it at that point. And that's when the banking journey really starts.
Yep. And one thing I also will mention is that first call or second call or even third call with your money mentor is extremely important, because I would almost say that sometimes we are the gatekeeper. If you want to get a policy, you have to go through us first, because we're going to be asking you questions so that we can see if you are a fit for infinite banking, if you have the right mindset for it, and if you're ready. And I'll be honest, like if you come to us and say, yeah, I'm kind of interested, and I'm like, okay, you're kind of a tire kicker, we're not going to move you forward in the process until you actually can prove that you're ready to go through it. Just being honest. But that starts with that call first. So, because there are some hoops you got to go through, there are some commitments you got to make during the application process. So just kind of something that, we want to be clear on. This is kind of a funny one. So Craig says, how many times did Steven throw up during the Steelers game? Not sure. He's not here. He had to step out to go do some coaching for some kid sports. So he's not here, but.
Oh, I thought he had to go get rehydrated from all the throwing up.
That's what I was thinking. He just told us it was a game. He's recovering.
Yeah, there you go. That's funny. Okay, so Jean Francois says, find me a lawyer in, I'm assuming that's Vancouver.
It is Ask Me Anything. So
yeah, you're asking that. Well, I don't really think I know any. Depends on what Vancouver, BC, Vancouver, Washington, Vancouver, somewhere else. But generally speaking, the question is going to be, why do you want an attorney, and what kind of lawyer are you looking for? And maybe somebody knows one there. Most likely not. I know quite a few attorneys. None of them are near me, because I really don't care where the attorney is located if I'm looking for advice. So like I have an investor attorney, acquaintance of mine. He's in Texas. Doesn't need to be near me. I just send him the contracts and he analyzes them for me. But interesting question, but I don't have an answer for that one just yet.
And good point. What does he need the attorney for?
Yeah.
Or she?
I have one that's $200 per month and one who's $650 per month or per hour.
I like how we try to still answer this question. So that's good. That shows a lot.
Yeah.
We try.
Yep. Okay. So Be Livin is saying, can this be used, referring to infinite banking, for a 1099 self-employed to shelter for taxes, or Social Security taxes? Well, where's that little banner? This is not
It's
financial advice.
it's not financial advice. This has been around longer than the IRS current codes that we're using, the tax codes. It's been around longer than the Federal Reserve. That's not Federal or Reserve. So you're not doing this you're just doing this so you're not paying Uncle Sam any more taxes than you have to. It's a good place to put money to build up for an opportunity fund. If you're not using it, that's okay too. But we're teaching you banking process. So you're building an opportunity fund. You're guaranteeing a legacy that's probate free and tax free. So it has all of those living benefits and the death benefit as well. So
yeah,
here's what I can just. Here's what I'm thinking. So your policy, doing a whole life policy, is not going to help you avoid Social Security taxes in any way, shape, or form. But what you might want to think about doing, what I would probably do, is since you're getting, your whole income at 1099, you're getting the whole check, you're having to pay Social Security taxes at the end of the year. What I would probably do is set money aside into my whole life policy throughout the year and then pay that Social Security tax bill out of that policy as a policy loan at the end of the year when taxes are due. Therefore, you got your money into a policy to where it is now guaranteed, protected, and compounding, and highly likely earning dividends for the rest of your life, even though you then did turn around and use it to actually pay the tax bill at the end of the year. That's one way I would look at it.
So, Linus, I was kind of thinking, in addition to what you just shared, I think they're talking about on the input side, if I'm putting money in premiums, am I going to be able to get away from taxes, Social Security taxes? No. However, if we look at the back end when you get into retirement, think of using the policy as a supplemental retirement tool. The money coming out of this policy, if it's done correctly with withdrawals to cost basis and then loans, which we can help you structure, that does not count towards the amount of income that gets calculated for your Medicare or your Social Security taxes. So it's kind of off the books. So in that case, it does help with any taxes that you would have on Social Security, but that's on the retirement end when you're taking withdrawals or doing loans.
Yeah.
So anyway, I just want to share that because it is a powerful strategy at retirement.
Yeah. The last thing I'll mention, a lot of times I come across this with self-employed people or business owners. They say, hey, I want my business to own the policy so I can deduct the premiums inside the business. And this is not tax advice. You got to talk to a tax professional, which we know those guys. Yes, you can do that, but what is the long-term consequence is the better question. Because this is what I was told. So yes, you can do that potentially. You have to have an agreement with the company and the individual being who's the insured. But if the business ever shuts down or the LLC goes away, then the ownership has to transfer out of the LLC potentially to the insured person. Now, all of a sudden, all those tax deductions are no longer valid, and then that person would owe a bunch of taxes because now all the deductions would not be deductible anymore and apply to them. But that's just kind of what I told you. You got to be very careful about that and make sure you get the right advice before you make a decision and to do that, because that can be risky from what I've heard.
And typically, if the business is the one benefiting from the policy, there's not a tax deduction there. And, star, we're not CPAs.
Yep.
But in the case where a business is doing a what's called an employee bonus or executive bonus type arrangement, once that employee then starts benefiting from that, that's a deduction to the business. It's taxable to the employee. So there are some different arrangements, but just as a self-employed, for sole proprietor or even an LLC, there's not much you're going to be able to do with getting away from taxes with just putting money in a policy.
Yep. So Rich has got a good question here. It says, can you explain why a policy that has a larger base premium, like a 40/60, is more efficient than a policy with a smaller base, like a 90/10? If the vast majority of your PUA premium goes to the cash value and nothing comes out to pay for the cost of insurance, admin fees, why is it said to be less efficient in the long term? Well, the answer to that question is oftentimes an opinion, to be honest, and it depends on what you're trying to accomplish once again. So I've done these policies, and so we've all done these things. A 40-60, 20 years down the road, is going to have more put into it than a 90-10 in most cases, because you can put in more over the lifetime of the policy, which means you're going to have more growth of the policy, more death benefit, more cash value than a 90-10. A 90-10, you cannot put in the PUAs, which is what you're referring to, paid up additions, for a long time in most cases. You're going to be cut off. Whereas at 60-40, you can put them in sometimes for 50 years. 90-10, I've seen it only allow it to go in for like 8 years and you're done. No more PUAs. So it's really about what you're trying to accomplish.
Yeah, and Brian, I mean, the challenge with this is, here's what I tell people all the time. If you want, let's say you're celebrating a big thing where you need a cake, maybe it's a wedding or an anniversary, and you're going down to the baker and you want a 3-tiered cake with truffles on it and whatever else. You just tell me what kind of cake you want, but you're not telling me how much flour and how much sugar and how much salt to put into the mixture, right? I'm just going to make you the cake. And so this is something that I think is really, really important for everyone to understand. Come to us with what you're trying to do. We'll talk about how we build a policy that accomplishes that, because frankly, there's holy wars over 1090 versus 75-25 versus 40-60. And I really don't care about the splits. I'm trying to build a policy that works for you. I'll tell you, I have a policy that has a 20-year term rider on it. It's an 80-20. I've had it for 17 years, and I've been able to continue shoving premium in it for many, many years. Is that the best policy for everybody? No, for what I was trying to do, that policy was great. But should we do a 40-60 and a 1090 for you? It just depends. And then the longer amount of term we put on, like Brian was saying, that 1090 might run out of steam. But if we put a 20-year term rider on it, it's not going to run out of steam until that 20-year. So you see what I'm saying? We have all these different ingredients that we can put in the bucket and stir it up so that we can make the right outcome for you. But hopefully that helps. But there's a lot of different factors that are going to determine, well, is a 40-60 better for you? Is a 1090 better for you? 75-25, 80-20? I mean, all those things are just numbers.
And we know people that are other IBC practitioners. They only do 90-10s, which blows my mind, because it's like, well, are you doing the best thing for your clients, or are you just pitching 90-10 and that's the only thing you're selling? Because how you use the policy is very important as well. And the last thing I'll mention is, Craig mentioned term riders. So there can be term insurance in all these policies. So is a 90-10 that has term insurance a true 90-10? Now, that's a kind of a interesting question right there, but it's anyway, there's lots that goes into these things, lots of ingredients, as Craig just said right there. All right, so Glenn Love has a good question here. I'm very eager to get started. What is the least amount to start a policy?
Ooh, Joe, talk about his thinking. Joe hasn't even said anything. Joe, can you speak today? Are you mute? What's going on,
I
Joe?
think his face got red.
I can.
Okay, you can. Will you speak, Joe?
So in regards to the least amount to start, every dollar that you run through your policy, I consider that your own credit union. It's your own bank. You will receive dividends on that money. That is the PUA portion of this policy. The base is the portion that we use for the death benefit to create this policy. The PUA is the portion that's the overfunding, the banking, the dividend paying, and the borrowing portion of this policy. When I do a call, I talk with the person and we see what is the least amount they can leave in the policy for the base. And then I build up the PUA with how much we can actually stuff in the policy. Now you satisfy the base and how much you don't have access to, and you're also getting the banking portion with the amount of money that you're running through to pay that credit card, to put into that investment, and to pay yourself.
Yep. And there's lots of different answers to this question. That's why the mentor call is so important. Because once you start to understand infinite banking, that question you have right there, it might change. Once you start to understand how this can work for you, Because for me, it's like, I don't want to know the least amount. I want to know how much I can put in based upon my cash flow, my situation, my goals. So that's what we help you with. And we'll put the link here in just a moment to schedule a call with one of us. And we can definitely dive into a bit more on that as far as details go. All right. Here's a good one. So from Mavi the Pilot says, when lending money using the Be Your Own Bank system, do you lend the money through your LLC or personal account? That's a good one. Now, this is personal. For me, I do it through the LLC. So I'll lend it. I'll give it to the LLC first as a owner deposit, I think they call it, however they do that, and then do an agreement out of that to whatever else I'm lending it to. That way I can get some deductions, other things and benefits inside the LLC and the kind of privatization and protection.
Yeah, an important distinction, though, and correct me if I'm wrong, Brian, but your policies are probably personally owned by you. So essentially you're taking a personal policy loan and then loaning or depositing it into your LLC before you go out and make a private loan. Am I right?
Yeah. And the way I think I've done it before is, I'm trying to remember because it's been a while since I've done it, is I had an agreement between me and the LLC. Yeah. And then I have an agreement between the LLC and the opportunity, or like the other lender or the borrower, I guess you'd say. So there's just a simple one pager to make sure all the documentation is there for the CPA.
And I've also heard too, be careful in how the verbiage you use in loaning the money to your company, because if you plan to sell your company someday, if you loaned your company money, that loan will get paid back to you at the time you sell your company. If you put that money in, you will sell it with your company. So be clear about what you want to do with that too.
Yeah, because I've had a lot of LLCs, and there's ones where I do an owner deposit, or was that what it's called? You just
capital
contribution.
Yeah, there you go. So that's different than obviously if you're loaning to your entity.
And then just know the consequences if you sell the company. The capital contribution goes with the company. The loan can be repaid if you sell the company.
So I think we need the banner with the
disclaimer. We are not CPAs. We are not giving you financial advice.
Here's the way I look at this is most people's LLC is simply a pass-through entity. Mm-hmm. And so we do want to keep the private money, your personal money and your business money separated. But generally speaking, any money you're lending through the LLC is coming right back to you on your personal taxes. So the question would be, what are you trying to do with this LLC? Because you're not really protected per se with it being a pass-through. So it's not that you've shifted any ownership outside of your name. So I don't know. The way I would look at it, if you're just getting started, I wouldn't say that's a requirement to get an LLC.
Yeah.
Further down the road, if you have other purposes for an LLC or you structure it in a different tax format other than a pass-through, maybe there could be some reasons to do so. But I'd say you could start with personal account or you could start with an LLC. I'm not a CPA, but anyway, that's the way I would look at it.
I lend out of both. I do it personally. I do it LLC, self-directed IRA, business account. There's like 8 different ways that I lend out. So it depends on how you want the money to move over the water. When you take it from your personal and go over the water to your LLC, do you want to take it back with an interest payment of $500 or $1,000, or do you want to do a capital contribution and take $20,000 or $50,000 back at a time? So it depends on what you're looking to do in the end too.
Yeah, and Joe, I think that's a good way to put it too, because as we think about it, you and I have similar situations where we might have a pile of capital inside of this entity. Well, that's the one that's going to do the lending.
Yep.
As opposed to, because like you said, you have to move it across that line, and there's consequences when you move money out of one entity to another. You can't just say, oh, I want this one to have $10,000 overnight. It has to be
documentation.
Documented. It has to be documented, and there has to be a reason for moving that money around. But
absolutely. Cool. All right. So Douglas Hardiman says, are these policies protected from nursing homes or other elder care institutions as we get older, kind of like our assets that would be in a trust?
Number one, big shout out to Doug. I got your email. I'm excited for another conversation. I actually ran this through a search engine, and I'm being told by the search results, whole life insurance policies are generally not protected. from nursing home costs, as they are considered assets that can be counted towards Medicaid eligibility. But a strategy like transferring it into a trust would now bring you back to that protection that you're talking about.
So the thing you have to think about with trusts, that word can mean many types of things. Could be a revocable, irrevocable. There's all sorts of types of trust. So if you're putting the trust into a revocable, well, it's still yours. The ownership is still yours. They're still going to be coming after that money.
Mhm.
The only way you would be able to protect anything from spend down with nursing homes and elder care would be to get it out of your name. And then there's typically a 5-year look back, even with all of that. So this really requires, that type of planning requires, licensed estate planning people to kind of put the plan together for you. But a lot of people think, oh, I'm just going to get a trust, and it's a living trust, and they move assets into it thinking they're protected, but they're not. That is not going to stop the nursing home from doing the spin down or, the Medicaid spin down.
And also, you got to be careful too, because some of the stuff can involve state-specific laws and regulations, because life insurance is state-specific for some things. So, a good option is to get a hold of, as I said, a trust attorney or a asset protection person, and they can help you understand the ins and outs of that state specifically as well.
Yeah, and then you've got the 5-year look back typically to deal with as well. So.
Yep.
A lot of people understand and own nothing and be in control of everything, but they also have to know that, like you said, there's different kinds of trusts. So if it's revocable, you own it. If it's irrevocable, now you don't. So that's where that sentence would come into play.
Yep. Sherry has a question here. How does owning multiple policies work?
The one who has the most wins.
Yeah.
No, you don't believe that at all. You don't believe that at all.
Hey, we heard on Wealth Webinar today that
80.
one of the clients, the Busey guy, has 80 policies.
My hero.
That's awesome.
I'm like, yes.
Yeah, I think I know a family that has like 73, but they have a huge family. There's like 12 siblings. A lot of them are married. Lots of insurable interests. So, I mean, Cheryl's probably wondering, why do you have more than one policy? Perhaps, like, what's the need for it? I get this question a lot. It can have a lot of different answers. I know I have a video that talks about how I went from broke to cash flow in 4 years with the policies, but each policy had a different job. Like, we just opened our 5th one, it has a new job, right? It wasn't because we had more capital to put into it. It was because we have another family member that's insurable that we're going to start building an opportunity fund for 8-10 years from now for when he's ready to get his first home or different things. So it can be a lot of different reasons, in my opinion. So,
So Cheryl, I guess the way I would approach this is we're typically setting up policies that can help you solve the problem and the cash flow that you have today. And look, 5 years down the road, you might have a lot more income. Maybe you had some passive income. Well, it's time to expand the system. Or maybe you started the policy out on yourself, and then you have a spouse and you want to build the system out. The things we want to always look at is the cash flow. Does it make sense? Is it time to create another one without putting you into a tough position? But the insurance companies don't care how many policies you have. They're looking at premium to income ratios. And they're looking at something called human life value, which is how much income are we protecting and replacing? And of course, that's based on your income and your age. And so those are things we can help you with on a call. But typically we're starting, where are you now? What are we trying to solve? How does a policy work with your current cash flow? And then we build from there.
There we go. All right. So Juju's World. This is a Vault software question. I have 3 previous policies, 2 with Guardian, 1 with Mass Mutual, and another vendor. I purchased the Vault software for a year, but I have yet to be able to enter the policies into the Vault. Is it because the policies are over 5 years old and from another person, not in this group?
Yeah. So the challenge is, if you think about all of the illustration types, and even Lafayette, just within the last month, they changed their format. So all these companies keep changing formats of illustrations. So we have these readers that look at those illustrations. So I would say if you haven't already submitted a ticket, that's one way to do it. And then another way we can do it is through just CSV, comma separated value formats, and import it that way. But we do support Mass, Guardian. So if you're having troubles with those, submit a ticket with those illustrations and we'll get you fixed. We'll get that stuff updated.
And Craig, aren't you usually looking for like the original approved illustration as well?
Yes.
So that is probably like a PDF file or something like that versus, if it's sometimes inside, because I saw this somewhere else that we were doing an AMA or live or something where someone was having a similar problem. I just saw it within the week. And I think in my mind, it was because they were pulling it out of like their policy contract.
Yeah. And Jason, you bring up a good point, because sometimes people will load their entire policy contract. We don't want that. Or they'll load an annual statement. That's not what we want either. We actually need what's called the illustration, the original illustration, and then we can apply in-force illustrations. But if you don't have those documents, you can oftentimes go back to your original agent. They may have them, or maybe it's in your original contract and we can parse it out of there. But we'll need those originals to get you in there.
There you go. Just wanted to share this comment. So No Garage Guy says, been following Vantastic. So that's Christy Van, by the way. The plan for Velocity Banking knocked out $21,000 in debt in 18 months. Awesome. Wow. Congrats. Recently saw your channel, Chris Noggle's channel, and have been watching as much as I can from you guys. So one thing why I wanted to bring up this comment is because we obviously Christy Van is someone we know very well, and our Vault software does support Velocity Banking and can map that strategy out for you. One of the challenges I hear from a lot of people that want to do Velocity Banking is, how do I map this whole thing out? How do I plan it monthly? What debts do I pay first? All that kind of stuff. But we simplified it working with Christy inside the Vault software, where it'll just map the whole thing out for you, show you what debts to pay out first, all that kind of stuff. So it's pretty amazing. I'm using it, of course. So it's awesome.
Yeah, and the Velocity Banking is, as No Garage Guy has experienced, we knocked out 21 grand in 18 months. Velocity Banking, you can move fast. It's the fastest way to get out of debt. When we bolt on Infinite Banking, that's a way to pay off the debt in conjunction to Velocity Banking and build wealth at the same time. So think about having speed and wealth building. That's really what we're putting together with the Velocity plus the Infinite Banking.
Yeah.
And the software will show you, like, it's awesome. Like, congratulations. Like you've changed your habits, and it's usually that's all it is. I bet you felt really nervous when you started with Velocity Banking. And we're like, I don't know if this is going to work, but I'm going to give it a shot. And then you saw it working. Then you had some progress. That leads to happiness, right? We all want to see progress on what we're doing. And then from there, you're like, oh man, this is awesome. Best thing ever. And now you're like, well, what's this IBC stuff? And now you're probably a little nervous again. That's why you're here listening to us. But it's the same thing. You got to work the system. Like in the Vault will show you. Craig likes to say, I use your line all the time, Craig. This is a no plan. This is what the banks would like you to keep doing, where you are profitable to them for a very long period of time. Here's math. Here's math with Velocity involved. And now here's math with Velocity and Infinite Banking involved. And the difference you'll see with the fourth option is now you have money recaptured, you have cash value, and you have a death benefit for generations to come.
Yep.
Which covers, I think, I don't know, was No Garage Guy talking about legacy? I think that.
Yeah, he was. And
it was part of it, yes.
Yeah, because he follows up here with this one. Says, I only save in my 401k, which, by the way, that's what they want you to do. So I need the loan from that for initial cash dump. My term insurance timed out, so I need insurance now. So that is one of the biggest challenges of term insurance, is that when we get it, we don't think about it running out. But then guess what? 20 years down the road, all of a sudden, we are no longer insured, but we still have a need for death benefit. That's why Infinite Banking covers or checks a lot of the boxes, saves money, replaces the banking functions, guaranteed growth, and death benefit coverage with a legacy, guaranteed tax-free. So it checks a lot of boxes at the same time, whereas term insurance checks one box.
We had some yep and exactly's from No Garage Guys. So he feels like we're in his brain right now. So get that man a link so he can go ahead and get his call scheduled with one of us.
Yeah, I put it. It's up there above. It's up there already.
He's probably going to go out and peel out in that hot rod there.
Here you go.
Well, it depends on where he lives, because right now I couldn't go 3 feet. Just
Utah, and it's not snowing in Utah. It's not snowing in Colorado, so it's.
I got snow. Yeah,
I think we got 2 inches just during this call.
There you go.
Well,
Wow.
keep it on your
Jeez.
side of the pond because I don't want it.
Yeah, no one
Joe?
leaves here. It's headed to you.
I got green
Joe,
grass
send
right
it-
now.
Send it to me, Joe. I'll take it.
You can have it,
No,
brother.
it always heads to Joe next. He's got maybe tomorrow morning and it's over.
Yep, it's
Awesome.
done. They said it's coming in probably about 6 inches or so.
It's gonna be 37 here tomorrow morning. That's nuts. I'm in a Coe, right? That shouldn't be that cold. That's Florida. That's Orlando. That's cold.
We just want to share with you.
You can take it. You can take it.
Yeah, you can keep it.
So I wanted to share this one. This is a really good comment by someone who obviously is, part of our group. So Craig says that. So I just let others know, I met with my money mentor originally, did not fully disclose my assets because I didn't want to get roped into larger premiums. And by the way, you'll never hear us sell premiums. Or by the way, we inform you and let you kind of make your own decision. But he says this was an honest mistake. So obviously with your mentor, make sure that you're honest with them because we can't give you the right information or the right paths to move you forward if we don't have the right information. So good. I'm glad you shared that, Craig. Appreciate that.
You know, I'll even share too. For those that don't know, I started with this journey because I was working in the insurance industry preparing financial statements. It was during lockdown, and my very first policy, I did my emergency fund because I still, even though everything made sense and I could follow the regulations and the laws and it all seemed legitimate, I was still scared. So I did the emergency fund. When I did the first loan off of the emergency fund, I never left my mailbox and started the second policy. Why? Because kind of what he's talking about. I was fearful. So I'll say the same thing Craig did. Disclose everything after you've dug in, learn, understand.
Yep.
Yeah. Fun fact is, the 2 things I hear the most on every single call is either this is too good to be true. There's usually like a spouse in the background. Ask them this, ask them that, because they don't believe anything. There's there's something wrong here. It's too good to be true. And then they come back later on the second call when we start the application process and they're like, man, I wish I would have known about this like 20 years ago or 30 years ago, depending on their age, right? And so, and the disclosure. So that's the first thing I thought when I saw the comments. And then the disclosure part for Craig, that's huge for us too. Like, we can't help you if you won't let us meet you where you're at and you feel like you're getting taken advantage of. This is really like someone said to me today, oh, I don't want to waste your time. I forgot about our call. I'm in a lunch meeting. And I was like, cool. He's like, so like, I'll reschedule with you and then you can teach me all about it. I'm like, no, bro, I'm not going to teach you all about this. You go learn, you weigh in, you do the work. And then I'd be happy to have a strategy session with you. Like, our goal here, and that's why we're doing this live. We're here to support your questions, to answer your questions. And then we're going to meet you and help you come up with a strategy when you believe. We're not here to make you believe. I think it's a big distinction I have over the last 4 years. Because before I just want to make everyone believe. And now we don't have to prove anything to anybody. You either think you can or you think you can. Either way, you're right, is how I feel about it.
Yep.
Well, I saw that you posted old dogs, new tricks, new trucks. Back in 2007-ish is when I first heard about this. Of course, we didn't have all the YouTubes and all the content out there. It took me a year before I actually got my first policy. So Mr. Engineer had to go through and figure stuff out. Now, I know Joe over here, what were you, 16 months before you got started? So all of us sitting here like, you should do this, but we were also in your shoes. We're like, I don't know about this. Took me a year. Took Joe, what were you, 16 months?
Yep, 16 months, and it cost me $150,000.
I believed immediately, Craig. I was just dead ass broke. There was nothing happening that was starting. It took me a while to get the capital up and do the first job Nelson talks about, which is make money, because I was transitioning out of corporate America. So,
yep.
And I worked in the insurance industry, so I thought there was no possible way they could know something I didn't, and they did.
All right, let's dive into some more of these questions here. So David says, has there been any discussion or research on using crypto to fund a policy? I've heard talk about tokenizing whole life on Providence. I'll be honest. I mean, I've been in the crypto game. I used to teach it. I built a course on it. I'm not involved in it anymore. I mean, I've had clients fund it with crypto, but all they're doing is taking the crypto, selling it, converting it to cash, and then funding the policy. I mean, as far as tokenizing goes and whole life and stuff, whole life has been around for.
Ryan, say that again, just in case someone goes back and listens to this and thinks that you just said that people are funding it with crypto, because they're not.
They're not.
They're
Because
selling
you can't.
crypto.
There's
Okay.
no way you can do it because crypto has to convert to fiat currency, US dollars first, then it can fund the policy. So I don't know of anybody that's funding it with crypto. They're selling the crypto asset to fund the policy. So that's really what's going on. Now, as far as tokenizing and whole life has been around for hundreds of years. Crypto's been around for what, 10 years, 2016 or whenever it's been. It hasn't been around that long. So yes, there might sometime down the road be some melding of these things, but I mean, I wouldn't go anywhere near it right now personally. That's not financial advice, but I would not go anywhere near it because that crypto space to me is way too young compared to infinite banking.
Yeah.
Too much risk.
There is a project out there. You may have come across it, maybe not, where they're working on having a type of whole life that can be funded directly with Bitcoin. It's not a live project yet. It's really just an idea that's being worked on. And as far as the actual whole life product to kind of use for infinite banking, doesn't look as great as what all the good stuff is we use currently. So it's probably something in the future, most definitely. But yeah, not currently.
Yeah. Ooh, I like this question right here. So RWJ says, I have a security mutual life policy and I just started the 3rd year last month. Awesome. Congrats. I called and asked for an in-force illustration. Took 3 weeks to get it. It started with my 4th year. Is that expected? Well, security mutual is a bit archaic sometimes when it comes to how they process requests, but I'm not sure who your servicing agent is. If it's us, call us first and we can get it typically quite a bit faster. In fact, I just requested one here a bit ago and I just got it here right now. Not security mutual, but I just got it within an hour. So there you go. But 3 weeks seems like a long time to get an in-force illustration.
The challenge is some companies allow agents to do it right off of our agent portal and some don't. SML is one that doesn't allow us to get it. So it takes a little bit of their resources to generate it for us. But yeah, 3 weeks sounds like it's maybe pushing. But Linus, do you have any experience with?
I've got it pretty quick.
I know you work with them quite a bit.
Yeah. Security Mutual does not have a system that can allow an everyday person like us agents to generate an in-force reprojection like that. They have to get it internally. It's quite a process. 3 weeks does sound like too long. I would probably suggest checking back in on that after the first week went by. But yeah, I mean, hindsight is 20/20, I guess. Craig, do you know on that, as far as it starting in the 4th year, that doesn't quite sound right to me. I feel like the first line should be year 3, but I may be missing something.
So he said he is just started his 3rd year. Yeah, it should have
year 3 on there and it should show
year
the
3. Yeah, year 3 won't have all of the premiums in yet. Year 4 and beyond should have everything filled out as if you've completed, the premiums for it. So, you should have a year 3 and a year 4 in there if you just started year 3.
I would say call SML Policy Services and ask about that. They can certainly explain that. They certainly know what they have there.
Yeah. Yep.
And every big company, every big mutual company, the service isn't always equal with who you get on the phone to help you. So I would say one thing is to keep being persistent and consistent with your follow-up. Like, just don't wait. Like if maybe it happened over the holidays, maybe there was nothing you could do, but just for anyone listening, like, be proactive. It's your money. So go find out what's going on. It's your policy. It's your asset. Go find out what's going on. Ask questions, keep asking. And this is not my normal. This is something that my wife is constantly telling me. Telling me, Jason, speak up, say what you want, be direct. Don't just say, okay, thank you. Have a good day. Oh, that's not what I ordered. Okay, I'll eat it. Like, don't do that.
She's awesome.
Yeah, go ahead, Tess.
Oh, I was just saying, we love Patty.
Yeah. I was just going to add one quick thing too, because I don't know if we established whether that particular person was working with our team, but we also have the implementation team, and I don't know if you've connected with them, but a lot of times they're another resource that can reach into the insurance companies to help get you those in-force illustrations.
Yep. So one question from No Garage Guy says, if I follow correctly, the death benefit increases as I make deposits over time. And that is correct, yes. It's actually the paid up addition portion of your premium and the dividends, by the way, as well. Those are paid up additions, add to the death benefit as well as the cash value. So as long as dividends are coming in and PUAs are coming in, death benefit goes up along with the cash value, which is a very good benefit to these policies.
Yeah. And that's what it always does every time, right, Brian? Like when your dividend buys a PUA, it always buys more death benefit first, then it gives you more cash value, and then it's likely to increase your dividends in that order.
Yeah.
That's how it works. Because it's life insurance. At the end of the day, we're just here telling you guys how to use life insurance differently. That's it.
So we've had this question before from Dex, not from Dex, but we had this question before. So it's for Joe. It says, with my outstanding loans on policies, should I pay loan or PUA case by case? It is a case by case basis, by the way, but Joe, you want to answer that one real quick?
Always money goes back to the PUA first in order to get cash value. And then once you fill up the PUA where you can't stuff any more into, then you can pay back the loan.
Yep. There you go.
Dex had another question down there I kind of wanted to hit on.
Whoops. Ooh. It says, so his other question is, I have loans out, so that's good. My term rider expires, so I'm assuming it expires soon. Will I still be able to deposit PUA large amounts? We have to look at the policy design.
I just looked at it last night. You'll still be able to put a good amount in there. It is probably going to be less than what it is while the term rider is still on it. So I would probably make it a priority to try to get as close as I can to maxing out PUAs now while the term rider is still on there. But I think you have a number of years left on that term rider yet.
There you go.
Dex had a good comment too somewhere. I lost it. I mean, I scroll back up, but
that's
earn while you earn, or learn while you earn. Learn while you earn. That should be a T-shirt. Somebody make a note of that. It should be a hat. Earn while you learn.
Yep, I like that one.
Dexter,
here's saying he started a policy. He just dipped his toes in to see how it works, and he's like, "Oh, I don't have this all figured out." I've been using this analogy a lot. You guys tell me if it's a good one, and Tess, tell me if it's a good one or not. But people are always like, "Oh, I've been doing a lot of research. I watched a lot of videos," and I want to be like, "You don't get a participation trophy until you start." Number one. So good job. Thank you for being curious. That's awesome. But it's like when we first learn how to drive a car, you don't go and read the manual. How do I adjust the mirrors? What do I do first? How do I turn it on? And then you're like, "Oh, I got this," and get in and start driving. No, you get in and you start adjusting stuff. You start doing stuff. It's the same thing with your banking policy. You have to be involved. You have to do things. You have to go look at your dashboard, go check out your cash value. The more involved you are, the more successful you'll be, right?
I do agree with you. I came from an environment of analysis paralysis. I would plan 300-point systems, not realizing that 3 points out, the whole thing changed. So you're right. I think you need to get in and then learn as you go, but continue to learn all the way through the process. I just tried to create these massive plans, wasting a lot of time because everything moves.
Yep.
Something else I wanted to say, Dexter, you have a One America policy with that 10-year term rider. Typically, or pretty much always, that term rider is only needed for the first 7 years to avoid MAC. So you actually have years 8 through 10 to actually convert the death benefit on that term rider into a new whole life without going through new medical underwriting to qualify medically. So that might be something to look into, as well as being able to convert that chunk of death benefit into a new whole life without just losing the death benefit entirely when that term rider expires.
Yep.
Linus, that's one of the things I learned while I was earning. I was so happy to find out, what we use for a dump in the term rider, we can actually convert it and we can convert it to a new policy. I was like, oh, this is beautiful. And one thing I see in some of the designs that we've done, and sometimes I worry that, and maybe Craig, this is just a thought I just had, is like when I see that term rider drop off in year 7, I know if they're not planning on converting it, right? For some reason, like that year 7 is the first year they can really convert that, most likely without mecking it. And so if it drops off before year 10, we're really taking away the ability to have choice in what year we want to convert it due to the cost of it. So
yeah, and it all comes down to, why did we build a policy the way we did? And could be someone that say, I got to get out of debt, want to capitalize, build some legacy, but then I'm going into retirement, so maybe I don't want to put as much premium in. They're okay with that. So it's back to the cake maker. We need to understand who are we making a cake for, how much flour and sugar and salt, and I don't know. I guess eggs go in cake too. I don't know what else goes in there, but I think so.
Yeah, there's some eggs in there for sure.
Yeah, you can get the eggs. So anyway.
No, it's a good analogy. I think the simpler we make the analogies like that, Craig, the better we'll do. I think it's just this is not complicated stuff. Now it does get very complicated, with all the different variations of it and how infinite it can be. Like it can feel really overwhelming. But at the end of the day, you're changing one thing. Where does your money go first? And you're making a decision on how much you're valuing yourself and how much do you want to pay yourself, and then what do you want to accomplish. So.
All right, a couple last questions we got here. So this one is from BYOB Mom. Says, what does the index dividend crediting option mean or work? And because I received a letter about it and don't understand it.
Paper airplane.
Yeah, it's One, we never really choose that for the dividends. We want dividends to actually compound and grow the cash value portion of infinite banking policies. If you do the dividend crediting option, it's now actually going into an index or based on an index. We don't want to be tied to the markets. We don't want to be tied to volatility. So we never choose that option in most cases for infinite banking. We want the dividends going into cash value. So
that question takes up a lot of my time though, because everyone always asks me about it, and I'm always like, make a paper airplane, throw it away. What do you mean? Actually, I had one not start a policy because she was reading the illustration. She thought that was a contract, and she's like, "What is all this?" And when she asked me the question, because I didn't have full context, I thought she was asking about IULs. I'm like, "Oh, that's tied to the market. You don't want to do that." She's like, "But it's right there," and I'm like, "What are you talking about?" So.
Yeah. I have a canned response I have somewhere that I just send or I read out when I hear that question, because I get it quite a bit too. But
yeah, mine's paper airplanes, trash can.
So last question here. So Rachel says, what is your opinion on direct versus non-direct recognition? Direct seems to favor in an environment with rising interest rates. Does this make it preferable than non-direct since interest rates have a floor but no ceiling? Or does it really matter in the grand scheme of things? I'll be honest. I mean, I have friends that are infinite banking practitioners that they'll do Penn Mutual direct recognition all the time. But to understand what's going on, direct recognition versus non-direct, what that means is if you have a direct recognition policy and you borrow from the cash value, that will impact or reduce your dividends. Now, some direct companies have a higher dividend rate because of this. But for us, oftentimes we prefer to do non-direct because it makes it simpler. It's clean. The forecast is very accurate. We don't got to worry about an adjustable dividend rate. Additionally, if you plan on using this as your banking system and borrowing from it, then you are going to impact your dividend rate with a direct recognition.
Yeah.
So,
and the interest rate you're earning too.
Correct. And it's called infinite banking because you're going to be acting as your bank, which means you're going to be borrowing. So, yeah.
Craig,
yeah, there's holy wars over.
I was going to say that. Damn it! I should have jumped in. I was going to say Craig is going to say there's holy.
There are. Oh my
well,
God.
there are holy wars. I mean, people are digging fox dens with their rifles, but realistically, the way I kind of look at the direct and non-direct, I prefer non-direct. Most of the companies we work with are non-direct.
As do I.
But to me, a lot of this comes down to if you have a direct recognition policy, you could use a cash value line of credit and get away from that problem altogether. The other thing you could look at doing is understand how are you using loans. So if you're taking long loans, and what I mean by that is sometimes you take loans out for debt, you don't pay it back for a few years. Direct recognition, that's going to hurt. If you take a loan out and you have it out for 5 years to do some project and they're paying it back, that hurts. If you're taking fast loans and paying them back quickly, it doesn't hurt as much. So I've done analysis on people that have come to us from other companies that said, I looked at my original illustration. I'm 5 years into this infinite banking thing, and the cash value that I have now is nowhere near what they said it would be. Did I get scammed? And I'm like, well, no, you've had a loan outstanding for 5 years. Your dividend crediting was reduced. Therefore, your cash value that you have now is much less. So that's just some of the things we have to look at. But I prefer non-direct, but I don't take a hard stance that it won't work if you have direct. It's just I prefer non-direct.
I don't like to get hurt. I like non-direct.
Yeah, I like that there too.
I mean, the Nelson Nash Institute, right? A lot of us are certified infinite banking practitioners, and everybody will be one day, right, Linus? So you're getting there. But they
don't have a
they don't have a stand on it because they both work for banking, but you have to work like a banker. That's the part that they kind of leave out. You have to work like a banker.
Yep.
Like if you're not working like a banker, I had someone come to me who's super successful in corporate America, saw me speak at a event before Christmas, got on the call with her. She started a policy, a couple $100,000 into a Lafayette policy, took a loan out, put it into an investment, and hasn't paid any of the interest, has paid nothing but $120 towards, the policy. So she's not capitalizing the policy. She's not paying back the policy. And now she has a lot of liquidity coming back from a lot of investments. And she wants to know if she should start a new policy. I'm like, no, not right now. First, pay back the simple interest at least, or pay back, make sure you're capitalizing your system, get that one on the right, get it on the up and up, get it healthy. And then if you still have more capital you're looking to put into a system and you want to expand, I can help you. But right now we got to help you take care of your banking system you have. So
be a responsible banker first.
So in your question where it says, since interest rates have a floor but no ceiling, maybe I'm misunderstanding something, but if you're referring to policy loan interest, those do have a ceiling. So
8%, yeah. 8% is the highest you could ever go.
Yeah.
So, but we did it again. I think Brian was about to wrap us up. We made it. We're at another, what are we at? 5:36 my time, or 5:30? Yeah, 5:36. So
2:36.
We went long here on the East Coast, out on the West Coast, and everywhere you're listening in between, and maybe left and right of us. So thank you for bringing your questions. Keep coming back every week. We'll be here asking or answering your questions, and maybe we'll ask you questions sometimes too. So keep showing up.
All right,
Thank you all. Have a good one.
See you next week.